question is, do all trading strategies eventually fail? Maybe your strategy isn't broken, maybe it's just quietly becoming less effective. Maybe the biggest mistake you can make is abandoning that strategy before you actually have enough evidence that it's actually decaying. Because strategy decay is real, but it doesn't necessarily mean that your strategy has stopped working. Sometimes it simply means that your strategy just isn't working as well as it used to. And I know this because I've experienced it firsthand. So in this video, we're going to talk about what strategy decay actually looks like, how to tell the difference between genuine decay and a temporary rough patch, and when you should actually make changes to your trading strategy. Because there's a big difference between protecting your edge and prematurely throwing it away. So let's start with the obvious question. What is strategy decay? Strategy decay is the gradual reduction in your trading strategy's effectiveness over time. And when we think about strategy performance, the first thing that usually comes to mind are things like your win rate or your annual return on investment. But the interesting thing is that those numbers aren't usually the first place you'll see the warning signs of decay, because there can be really subtle changes happening underneath the surface before your overall profitability is affected. I'm talking things like maybe your average winner starts getting smaller, maybe your losing periods start lasting longer, maybe your drawdowns are becoming larger and more frequent. Maybe the strategy is still profitable, but it takes more trades to generate the same amount of profit that it used to. These can all be potential warning signs. And this is a very important distinction because strategy decay doesn't necessarily mean your strategy has stopped working. Sometimes it simply means that it stopped working as well as it used to. And there's a huge difference between those two things. Now, when it comes to strategy decay being real, this is where things get a little bit more complicated because yes, strategy decay is absolutely real, but it doesn't mean that every single trading strategy is going to experience it or experience it in the same way. And it certainly doesn't mean that every trader is eventually going to wake up in the morning and discover that, hey, my strategy just all of a sudden stopped working. In fact, you can experience strategy decay and still have a very profitable strategy. And trust me, I lived through this myself. My journey in the Forex market started in 2009, and that was right around the time of what was called the Great Recession here in the US. And for those of you who aren't familiar with the Great Recession, it was pretty much the longest and most severe economic downturn since World War II, largely driven by the collapse of the housing market. And if you've ever seen the movie The Big Short, well, that's exactly the environment that movie was representing. Anyway, after the recession was over, we saw some pretty significant volatility in the Forex market, particularly between the period of like 2009 and the beginning of 2011. And although volatility doesn't necessarily equal profitability, right? You still got to know what you're doing. You can have volatile markets and be bad and you're just going to lose money faster. But if you do know what you're doing and you do have the edge, then let's just say it was a very prosperous time to be a trader. And here's where that becomes relevant. I still trade many of the same strategies today that I did back then. And do they perform the same way that they used to back then? No, they don't. Market volatility has changed, market conditions are different, and naturally, the performance characteristics of some of those strategies has changed with them. But the thing is, they're still profitable, and they remain a staple in my trading portfolio. And that's a very important lesson to understand when it comes to dealing with strategy decay. That being, a strategy can decay without necessarily dying. And I bring this up because I think it's very important for traders to have a realistic understanding of what strategy decay actually means. Because I see traders make two completely opposite mistakes. On one hand, you have the trader who calls strategy decay way too early. They test or they trade a strategy for a week and it doesn't make money and all of a sudden they yell, strategy decay. Or maybe they trade it for a month and they hit like a drawdown and then they yell, strategy decay. And what they do is they then use that excuse to jump to the next strategy. And the problem is they never really gave that original strategy enough time to actually prove itself, right? Law of large numbers. Instead, they're constantly searching for the perfect system instead of developing the skill necessary to properly evaluate their system. And then you have people on the opposite extreme. You have traders who are so emotionally invested in their own strategy, especially if it's something that you built yourself, that they refuse to acknowledge the warning signs. They've spent months or maybe years developing this strategy. They're personally attached to it. They believe in it. And because of that attachment, they ignore the data that is telling them something has changed. And what happens is this: they end up sticking with the strategy too long. They refuse to make any tweaks or adjustments. And eventually, what could have been a very manageable problem becomes a much bigger problem. So you see two extremes. One trader abandons their strategy too quickly. The other one refuses to abandon it at all. And neither of those approaches are particularly intelligent. So the real question then becomes, how do you know if your strategy is actually decaying? Well, it starts with committing to a consistent journaling process. Keyword consistent. And when I say journaling, I'm not just talking about like logging your trades and recording whether you won or lost or how much you won or how much you lost. Yeah, that's part of it, but I want you to go much deeper. I want you to track the technical details of your trade. What setup did you take? What was the market environment like? What time frames were you using? What were any conditions surrounding the entry? How did the trade perform? Things like maximum favorable excursion, maximum adverse excursion. That list can go on forever, but I really want you to dig into the trade, analyze it thoroughly, and find out, was there something I missed, or was there a better way that I could have handled this situation? And sometimes they're not, don't get me wrong, but a lot of times there are, and those are the little clues that are going to become very important later on. As always, while we're on the topic of journaling, of course, we want to track the psychological side as well. How are you feeling when you took the trade? Did you follow your rules? Did you hesitate? Did you force anything? Did you do anything differently than you normally would? And I say this because sometimes what looks like strategy decay isn't actually strategy decay. It's trader decay. We call this a self-inflicted drawdown, meaning that your strategy may actually be perfectly fine. You just aren't executing it the way that you used to. And that's why the data is important. Many of you guys have heard this story, but I love sharing it because it was this action that was really the turning point in my trading career. It was the period where I went from being this close to quitting. I had already made up in my mind that I was done, to ultimately finding success. And I'll make it short. Pretty much, I had gotten to the end of the year. My trading performance wasn't the way that I thought it was going to be. And of course, like any new trader, I blamed everyone but myself. The economic conditions, the market, the president, the nature, right? Whatever I can think of. And what I decided to do at the end of the year was do a full audit of my trading performance. And I did what's called an A/B split test. I took all the trades that I took during the year. I created 2 columns on a spreadsheet. Column A was what I actually did. And then column B was what I should have done if I followed my plan correctly, meaning I didn't make any psychological mistakes. And what I found was that, well, there was a massive difference between column B and column A, meaning that if I took all the trades in the way that I was supposed to take the trades and I did not make all the psychological mistakes, I actually would have had a very profitable year. And what that taught me was that, hey, my strategy is not the problem. It actually works pretty good. The problem is the dude looking at me in the mirror, this guy. So what I did was I set a goal to limit my mistakes. I was making a lot of mistakes. And instead of just going straight to zero, going cold turkey, because that rarely works, I decided to create a plan where I said I was going to make 1 less mistake each month. So as the new year began, if I made 30 mistakes in January, which probably wasn't too far out of the norm, my goal in February was to make no more than 29. If I made 25 in February, then March was to make less than 25. And this was a very process-oriented goal, but what it did was it took my mind off of the profits, which is what caused many of the psychological mistakes, and I finally focused on just executing my plan 100%. And that's why journaling is so important. Speaking of which, watch this space. We're talking about a date right now, but maybe August 27th. We're going to do a nice little 1-day workshop because we are launching a new website. And one of the cool things with that new website is a brand new trading journal where you can track all the things that I just spoke about, both on the technical side and on the psychological side. So that's going to be really, really, really cool. I'll give you more details once I know about it, but We're thinking August 27th, so just kind of reserve that day. So while we're on the subject of journaling, I want to share a habit that I do personally when it comes to my journaling and a review, because I said consistency is the key. So personally, I like to do a major review of my trading, so pretty much like an audit of my performance every 3 months. And the reason I like using 3 months is because I'm a swing trader. So the duration of my trades lasts a little bit longer. And what that means is that having a rough week isn't too unusual. Having a rough month isn't necessarily unusual either. And therefore, it wouldn't be fair to completely judge my strategy's performance based off a few weeks or a month. It's just not a big enough sample size. But over a 90-day period, I can usually start to see whether something is meaningful or not, right? Again, maybe an average winner is declining. Maybe a certain setup is underperforming. Maybe a particular market environment, Trump tariffs, for example, is causing problems. Maybe my drawdowns are lasting longer than they usually do. That 3-month review gives me enough information to identify potential trends in my trading strategy. But, and this is important, I don't make any changes simply after 3 months. For me, the earliest that I can ever make a change in my approach is after that 6-month period. That's when I'm comfortable making adjustments to my plan. So what I do is I identify any potential problems within those first 3 months. Then I give myself another 3 months to track it. Does the problem persist? Does the problem get worse? Or does the problem correct itself? And in many cases, you'll discover that what looked like strategy decay and had you all panicky was simply a temporary blip and performance returns to normal. And now, since you've given yourself that time, you avoid making an unnecessary adjustment that might have had a negative effect on your performance. With that being said, sometimes the problem does persist. And when that's the case, you have to be willing to make a change. One of the biggest adjustments that I made in my trading career actually came during one of these low volatility periods, right? Talk about boring markets. I noticed that one of my strategies wasn't really performing the way that I expected it to, and there were some red flags after the first 3 months. So what I did was I identified the problem. I then tracked it for another 3 months. And as that problem persisted, at that next checkpoint, the 6-month period, I implemented a solution. And what that adjustment did was it helped me steady the ship for the final 6 months of the year. And having the ability to make those adjustments, that's what real trading is about. Instead of being married to your strategy, you're married to your process. And this brings me to something that I think is extremely important, right? There's a massive difference between being a trader and a system follower. A system follower doesn't necessarily have the skill of trading. They do have the ability to follow rules. And don't get me wrong, that is not easy by any means, right? Being disciplined enough to consistently follow a trading plan is incredibly difficult. And that's the reason that most traders don't make it, unfortunately. But when it comes to longevity in this industry, and you can ask any professional trader out there, I believe that having the skill of trading is much more important, because the skill of trading is what allows you to adapt. It allows you to look at your data and say, okay, something changed. Why has that changed? Is it temporary? Is it permanent? And if something needs to be addressed, what can I actually do about it? Think about your car, for example. If your car suddenly stops running as efficiently as it used to, you don't automatically assume the car is worthless, right? You take it to a mechanic. You figure out what changed. Maybe something needs to be replaced. Maybe something needs to be adjusted. Maybe something just needs to be cleaned up. And then once you fix that problem, the car goes back to performing the way it should. And it's a lot less expensive than buying a brand new car. Your trading strategy could be very similar, right? Sometimes the entire strategy isn't broken. Sometimes there's simply something that needs to be adjusted. And that's where the skill of trading becomes incredibly valuable. Another thing that can help you manage strategy decay is having a trading portfolio. We actually talked about this in episode 1357 of the Trading Coach podcast, which was an audio only episode for you guys that are watching on YouTube. Make sure you head over to your favorite podcasting app and check out those episodes as well. Lots of gems over there on your ride to or from work, or while you're busy working around the house, or while you're perusing the charts, right? Little background information is always good. Anyway, having a fully developed trading portfolio isn't going to necessarily prevent strategy decay, but it absolutely will help you manage it. Think about what happens when you're trading one asset with one strategy, right? All of your eggs are in the same basket. If that strategy starts to decay, you're under a tremendous amount of pressure because your entire trading business is depending on that one thing continuing to work in the same way. Or now imagine yourself having multiple strategies or multiple assets or multiple strategies across multiple assets, right? Now, if one of those strategies is struggling, your entire account doesn't have to struggle with it. Other strategies can continue to produce while you investigate what's happening with that single underperforming strategy. And I think real estate is a really good analogy for this, right? When I first got started in real estate, I owned a single property. And I learned really, really quickly that owning a property comes with lots of things that can and will go wrong. You have a tenant that doesn't pay. You have a water heater that suddenly burst at midnight. And guess who gets a call to deal with the damage? Yeah, me. And those situations are very similar to strategy decay, right? The property isn't producing the way that you expected it to. And during those periods, it's going to drain money from you. But eventually, we had multiple properties and those same problems didn't have nearly the same impact. Why? Well, because even if one property is draining money, the other ones are still producing income. So overall, the portfolio is continuing to perform. And at the same time, we could evaluate that dumb property, right? And if we determine that the issue was temporary, we fix it up and we keep it. But if we determine that the problem is more permanent, then eventually we would sell the property and replace it with something else. And that's very similar to what we should do in trading. If you have multiple strategies, you don't necessarily have to panic the moment it starts underperforming. You can continue to operate your portfolio while you evaluate the problem. And if you eventually determine that the strategy really has lost its edge, well, you can remove it from your portfolio and replace it with something else. That's why I believe that one of the easiest ways to reduce the risk of failing when it comes to trading is by diversification. Again, not because it magically eliminates the risk, but because it prevents the entire trading business from depending on a single source of profitability. And when you're dealing with something as dynamic as the financial markets, I think that's a pretty powerful advantage. So the next time your strategy goes through a rough period, don't immediately assume it's broken, but don't blindly assume that it's fine either. Collect the data, review the data, give it time, and then make your decision based off the evidence, not off your emotion. Because your job as a trader isn't to find a strategy that lasts forever. Your job is to develop the skill to recognize when your edge is changing and know what to do about it if it is. Speaking of failures, if you want to hear a wild story about one of the biggest broker failures in US history, check out the video I did titled "I Lost Everything to a $215 million Trading Scam. But here's what I learned." And that story is one of the biggest reminders that I've had that in trading, risk management goes well beyond just where to put your stop loss or how much to risk per trade. Subscribe, like, follow to support what I'm doing here. And as soon as I know more about that end of August workshop, I'll let you guys know. See ya.